Hey everybody, it's Chris, and welcome to Life 180. And this is going to be one of my first lives of what I'm going to be trying to do on much more of a regular basis. Ultimately, what I'm going to be doing here is thinking about what's going on for topics out there in the financial space. It can be politics, it could be financial related, it could be economic as far as the economy goes. It could be strategies for financial advisors, life insurance agents. And today, ultimately, I was having a conversation with somebody earlier, and it kind of spurred me to want to do this kind of last minute. And so I was having this conversation with somebody about why everybody should want life insurance. More importantly, why everybody in the world should want to have an and asset, as we call it. Now, what do I mean by that? So an and asset is simply a properly structured whole life insurance policy. It's more than that because it's a matter of how does that policy fit into an overall strategy. And so now I'm a big believer that people make decisions emotionally and they validate those decisions with logic. And so one of the things that holds people back from taking action and doing the right thing for themselves is like emotionally holding on to the construct of what they think is true. So one of the things that I want to challenge you to right now is if what you thought to be true turned out not to be true, when would you want to know? And I think for most people, if you're anything like me, that is right now. And so what I'm going to do is get into a little bit of this life insurance stuff and talk to you about what I think the number one reason is, and it kind of stems to emotion and it stems to logic, and that is life insurance, when properly structured, is the only financial vehicle in the world that will make sure that what you want to happen will happen when you want it to happen, whether you're here to see it or not, right? So, like I said, I'm going to get into some charts and some graphs and kind of show the math behind what I'm talking about here. But ultimately, whether you're looking to save for retirement and retirement income, whether you're looking to save for your kids' college, if you want to buy investment properties, if you're looking to just protect yourself against downside risk in the market, there's tons of different objectives that people have with their financial goals. There's tons of different results that we all want to get in life, right? So it's not a matter. I always tell people it's not a matter of like what I think or what you think. It's really it's a function of figuring out where do you want to go, and is what you're currently doing getting you closer to where you want to go, and do you even know if the answer is yes or no? Most people don't have a clue if what they're currently doing is getting them closer to their desired result or objective. They just kind of are doing it because they're told they should be doing it this way, and then it's just they're kind of praying and hoping that it's going to work out the way that they want. And now the reality is hope is not a strategy when it comes to planning for your financial future. Now, I always kind of tell people control is the number one thing that we need to have with our money. We need to increase cash flow and we need to have control of our money, because if we give up control of our money, then we lose a lot of opportunity. And so what are the things that keep us from having that opportunity? It's losses, first and foremost. It's taxes. It's fees. It's inflation hurt our ability, right? Those kinds of things are crushing our ability to actually have our money grow and compound, right? And ultimately, everybody knows we want to take advantage of compounding interest as much as possible. And so what I'm going to do now is I'm actually going to share my screen. Let me see if I can flip this over here. And I am going to go to this screen here. I had you on the preview screen for the YouTube stream there so I could see it. So I can't see any comments right now, but if anybody's leaving any. But so this is what I want to get into really quickly. So what I did was I took an illustration from an and asset that I did with Caleb at BetterWealth. And I put it in here, and we did a 25-year time horizon, right? And you can see here the blue is the and asset. And so basically, I want to go through and talk about the comment that I made before, where life insurance is the only financial vehicle in the world that's going to make sure that what you want to happen will happen when you want it to happen, whether you're here to see it or not, right? So what are we talking about? So if you think about the fact that listen, I'm a father, I'm a husband, I've got 3 kids between the ages of 2 and 9. And so even if my kids were a little older, I think this still applies. For me, I want to make sure that when I die, if something tragic happens, or if I live a long, healthy, fruitful, productive life, that my legacy is what I want it to be, right? So it's a big legacy play, and it's also a play that will make sure that you have a financial system that you can leverage for while you're alive, right? So here's the deal. If I'm putting 20,000, you can see the premium here is 20,000 a year. Now, when I do that, this is basically based on a 60-40 base policy, which if you're not sure what that means, go watch some of my other videos. The video on how to properly structure a whole life policy will explain all that. I actually did a new one with Dan Kaminsky at BetterWealth a couple of weeks ago, maybe 3-4 weeks ago, and it goes through the different policy structures that you can do and just understanding that. But for the context of this video, just know this is a 60-40 base, meaning 60% of the policy is going into paid up additions and 40% is going into the actual base premium for the insurance. Now, so you'll notice 60% of the cash is available right here. So out of the 20,000, 12,000 is available at the end of year 1. What does that do? That picks you up a death benefit. Now, one of the things that really steers people away from whole life insurance, and I don't like to get too like numbers oriented with this stuff a lot of times, but I think it's important people understand them. One of the things that people hate about it, typically, if they don't understand all the moving parts, is they say, well, this kind of sucks. Why would I take $20,000, pay a premium, and get $12,000 back and have access to only $12,000? Well, I will tell you that when you do this, it's part of like investing in the system and in the process, because you can see here that year 2, when you do it, you only got 24,000 at the end of year 2. At the end of year 3, you're at you're at 43, and then it kind of goes up, from there. And ultimately, there are different ways to structure this. You can actually make more cash available at the beginning. That's not the purpose of this video. Once again, the purpose of this video is to talk the principle. Let's say you have this $12,000, and that $12,000 is liquid, it's accessible, so on and so forth. Well, guess what? When you come over and look at it and you say, okay, I put $20,000 into an investment account, whether it's a 401k, an IRA, a Roth, or whatever, that money grows. Well, what is the liquidity of that money if it's in an IRA, for instance? The liquidity is 0, because when you put that money, if you're 40 like me, and let's say my time horizon is till I'm 65, right? Which would make sense for this example, where I ran it out 25 years. So if my time horizon is till I'm 65, I can't touch this money. Even though it says 21,200 is the value, what is the real value of that money if I'm not able to touch it, right? The only way I could actually touch this money if it's in an IRA would be to pay my earned income taxes on it plus a 10% penalty by taking it out. So to really figure that out, I would have to reduce that off of the number to figure out the actual value of that account. Not to mention, like if you look at the full financial picture right now, if I had something happen to me and I passed away, if I got into a tragic car accident, if I ended up having some kind of heart condition I wasn't aware of or something, I dropped dead, which I actually know somebody that's happened to, it's a situation where their heirs are left nothing. Furthermore, if it's in an IRA or 401k, it's going to be taxed on a different level, of course, unless it's the spouse. But the other heirs, as it passes generationally, are only going to inherit, and I'm just giving rough numbers here. I assumed a 30% tax for the inheritance on this account, which is pretty accurate, I think, trying to be conservative. But they're only going to inherit $14,000. Now look over the life insurance. Even though you actually have $12,000 liquid, that's not how much is in the account. That's how much you have liquid available in your account. You have none in this other account. Plus now you have $843,000 in life insurance. Think about that. So when you look at the two different options, it kind of seems like a no-brainer to me, because when you work it out, if you were to say you have to pay earned income and penalty, ultimately, if you wanted to be able to access this $21,200, after paying your earned income taxes and penalty, you're going to be at about 30%, which is about what I had for the heirs. So this value of this account is really only about $14,480 if you think about it. So when you're thinking about and looking at the value of life insurance, when you're thinking about, okay, what is this actually doing for me? Well, it's building the foundation of a system. Oh my gosh, I'm so sorry. My landscapers are here and I'm in the front of my house and it's getting loud. So hopefully it's not too loud. I apologize. I did not know they were coming. So I'm going to try to get through this for you. So $20,000 is going into this account every single year. So you can see year 2, the death benefit goes up, the cash value goes up. And mind you, that's going up in your other account as well. But let's go 1, 2, 3, 4, 5. In year 5, check this out. Year 5 in your other account, if you're getting a 6% rate of return, which is pretty standard after fees. I did that because there are going to be expenses in your account. I assumed a 6% rate of return. Why? Because that's saying you have an 8% rate of return in the market, minus out the 2% managed money fees, product fees, mutual fund fees, 401k fees, all those fees that come into it. If you're an average person, you're going to find they add up between 1.5% and 2% at the best. I've seen some where it's worse. It's disgusting. So I'm taking a 6% net return after all expenses for your money manager, right? Or whoever's managing your platform. And so if you go to year 5, you have $119,000. Now, it's easy to look at that and say, okay, I got $119,000. I only have $88,000 in the whole life insurance contract. Okay, well, what do you not have in the 119? You don't have liquidity. If you want to make that liquid, what do you have? You only have $83,000. Check that out. So now you're behind the 8 ball. You're actually $5,000 behind where the life insurance contract would have you. By the way, this is on a guaranteed basis, right? This whole life policy is going to perform this way on a guaranteed basis, whereas there's no guarantees that the market is going to actually perform at this 8% rate annually. We could have a couple bad years, especially right now. We're coming up at the end of a bull market. I think we all know that COVID has happened and so on and so forth. So I think right now, most people are realizing we're due for an economic correction. And the crazy part is, so we don't know if this investment return type projection would perform this way. We're extremely confident because this is going to be guaranteed that this is going to happen this way, right? So when you think about those two things, it's kind of mind-blowing when people just don't see this, because if you wanted to access this 119,000, you're only going to have 83,000 available after you pay earned income and penalty, right? That's a big thing to understand. Plus you have over $1 million of life insurance. So you have no life insurance over here. And if you did want to get life insurance, let's say you go the buy term and invest in difference conversation. If you wanted that life insurance, then you're going to have to, have an extra expense. I could add other columns and I could say how much is $1 million of term insurance going to cost? But the thing is, even term insurance, if you were to buy it at the beginning and you were going to hold on to it and you bought a 20-year term policy, think about the fact of the way inflation works. If you buy $1 million term policy year 1, by the time, if you died year 19 and you still had $1 million, 19 years from now at 2% inflation, that policy is only going to have about maybe $650,000 in purchasing power in today's dollars, right? So it's really only like the equivalent of a $650,000 term policy in today's dollars, if that makes sense, because inflation just erodes the value of term policies. It just does. And that's one of the great things about having the policy set up with a whole life policy, the way that we structure it, with the death benefits constantly increasing. So that's another thing. The other thing that I like to say is when it comes to retirement, there's a big thing when we talk about you have the accumulation phase of your years where you're working and you're accumulating money, you're saving, and you're going from there. And then you have the distribution phase when you retire and you're no longer adding money to your account unless it's earned interest inside of the account. You're actually distributing the money to yourself. You're taking that as income. You're living off it. You're reaping the fruits of your labor over the years and benefiting from that, right? And so what happens here? Look here and you see, once again, a lot of people would look at this and say, well, Chris, this makes no sense. 25 years from now, I have $845,000. Okay, that's fair. Over here, I have $1,163,000 after everything's said and done. So why in the world would I want this? Well, let's just say, I'm going to run some numbers here. So I'm going to say equals this. Let's just say you're in a 25% tax bracket. So that means you get down to $872,000. If you're in a 25% tax bracket, this $1,163,000 isn't ultimately worth $1,163,000. It's really worth $872,000 because you don't have access to this tax-free. When you do have access, if you access it properly, you have access to the $845,000 completely tax-free. So think about that. Yes, you're still a little ahead on the money side, but if I told you I could get you here on a guaranteed basis, and there's no guarantee you're going to get to this point in time with your retirement account, what would you say to that? Furthermore, let me go a little further. What happens if instead of a positive year and having 6% return, because remember, the one thing we know is this is not guaranteed to look like this. Or I should say it's guaranteed to not look like this, because it's not going to go up 8% every year and then you pay your fees and so on and so forth. You're going to have negative years. You're going to have some bigger years. The goal is that it averages out. I do another video called explaining and educating to people as to the difference between an average rate of return and a real rate of return. I'm going to be doing a lot more education on that concept here coming up. So be on the lookout. Make sure you subscribe, hit the bell, get notified every single time I launch a video, because those videos are going to help you a lot. But let's just say we have a really bad year and you want to retire at 65, you're 64, and then all of a sudden you have a negative, 25% year, right? Then all of a sudden, bang, this account goes down because right at the absolute worst time possible, right? And this happens, I cannot tell you how often I have seen this happen during economic crises, 2008, 2009, this was happening all the time. I was talking to people in 2014, 15, 16 that were still working, that had planned on retiring in 2008 or 2009 or 2010. But because of the way the retirement accounts performed during those years and got just hammered and lost so much value, they were still working 6 years later. And you don't want that to be you. And it's a real risk when it comes into it. Furthermore, if you retire and your account value is fine, I'm going to just undo that number, just get it back to where I was. If you do retire and your number's fine, well, then you start the distribution phase of your retirement. And so you need to make sure that this money doesn't just stay here. You have to have a plan to guarantee income as you go through your life, like as you go through your retirement years. Because if you don't, if you have, let's say this account is doing well and you're able to live off the 6% on this, for instance, and you just did 6% distributions and the market did an 8% return after your fees, you got 6% return net value in your account. And so it was basically a break even. You were able to live on, let's say, $72,000 a year or something like that. Something in that range, $70,000, plus your Social Security, plus anything else. Mind you, 25 years from now, $72,000, guys, it's not $72,000 in today's dollars. Think about it. Like in the 1980s, $100,000 was worth a lot more, got you a lot further than it does today, right? And so that's something to contemplate. Like, what is $70,000 actually going to get you 25 years from now? Probably not nearly as much as it gets you right now. So if you have about a 5 to 10 year window where you're really exposed during retirement, and if you have this retirement account over here, let's call it a 401k or an IRA, and you're using this money to take income off of or any account like it, and then you have a big negative year anytime when you're first taking distribution and you're not adding to it, and you don't have a strategy to make sure that you don't have to lock in your losses, so to speak, and take income or take distributions or withdrawals from an account that is negatively performing, because when you do that, you you compound the problem so much more. And so it's really key to understand here that as you're going through this, that you really look at life insurance with a different lens. And when you look at this, it's not a matter of, okay, what are the values? I mean, I just spent a couple minutes like really blowing up the notion that the values in retirement accounts aren't that much better. And furthermore, they're not guaranteed. So if I had gave you the option where you could get this on a guaranteed basis, or this minus taxes and everything on a non-guaranteed basis, I think most people, when they understand the nature of how the taxes work, would go with this. Furthermore, look at this. You have no liquidity in this until you're 59 and a half without paying penalty. And when you do, even when you do, you pay interest, or you pay taxes, not interest. You pay taxes. So as you go through the and asset liquid value, check it out. By the time I'm, let's say year 8, I'm doing this, I got 164 grand. If I want to buy a real estate property there and invest in a real estate property, that's why we call it the and asset, because yes, this account is growing like this. You're never going to interrupt compounding, and you're always going to have control of your money. So that's a system that allows, if you're somebody who is creative, somebody who wants to do real estate, somebody who's an entrepreneur, I've worked with people who fix and flip cars who use this strategy, people who fix and flip houses, people who do hard money lending using these policies, people who, buy cash flow real estate properties using an and asset account. And so it's those sorts of things that are super powerful. And at year 8 here, if you wanted to go out and buy a $140,000 investment property, and I know probably for a lot of people watching this in California and New York and the Northeast, that seems like an absurd expectation to be able to buy any kind of real estate for $140,000. But I can tell you, I work with people who do turnkey real estate, where you can get a turnkey real estate property for $140,000 all day long in the different parts of the country. And so it's just, don't get locked into the mindset of what's going on in your local territory. What I do know is a lot of times, and I don't mean this as an insult to anybody, but people lack vision because they don't understand the dynamics of how the financial system works. They don't understand the options out there as to what is available for creative investment strategies. And so when you get into this and you set yourself up with an and asset vehicle, that gives you uninterrupted compounding, it gives you control of your money, and it gives you access to just a world of opportunity that you're never going to have anywhere else. Because remember, if I could then buy this real estate property, and I actually did another video that showed this with Caleb Williams up when I was at the BetterWealth studios, and it showed the value of, if you just take this and do it with one property, buy a cash flow property, take the revenue, the rental income that you have from that property, pay back your loan, because remember, even though you take a loan against your policy, the compounding of your policy never gets interrupted. You will have some expenses and stuff to manage that loan with the insurance company, but this is all going to look the same no matter what. You use the rental income to pay back the loan to the insurance company, and then now you have all of this money, plus you have another rental property. And when that loan gets paid off a couple of years later, you could do another one and another one. So honestly, like in this time horizon, you could probably have 2 or 3 properties on top of this cash value. And when you take that into consideration, you look at the cash flow that's created from that, you look at the equity that's created from that, and you look at the tax breaks and advantages that come from having the depreciation that you're able to write off on your taxes from a rental income property. This thing compounds itself in a way that literally no other financial strategy in the world can touch. But what I always kind of tell people is, it doesn't really matter. What I think what matters is you really thinking about, where do you want to go? What result do you want to create in your life? And is what you're doing getting you there? And if you're not sure, if you have questions, you can feel free to reach out. We're happy to help you. We're happy to walk you through a process. This is what we do. Happy to help in any way possible. We've got some of the best people available. I can connect you with contacts in the industry that honestly would serve you in a way that probably nobody else in the world is going to be able to serve you and help give you answers to the questions that you have. So I would really think about this. And if you have any questions, once again, you can leave them in the comments. You can reach out. You can go to life180.com. I've got a calendar tool there. I think there's a calendar link down below in the description. You can go check that out. Also, I just created a new membership platform, which I'm really excited about. I've been doing a lot of stuff over the past several months. I've been getting really focused on creating my agent training programs. I've been working with agents, helping them do their marketing online for a long time. I've been doing this for years now. And it just kind of hit me where, you know what, there's a lot of newer agents. There's a lot of people who are wanting to learn this stuff, who are wanting to get the information, who want the training, who want the coaching. And they're not able to get it. And I know that most companies' training kind of stinks. It's subpar. It's not getting you the education and expertise that you need to be able to go out and help serve your clients and sell and make more money, quite frankly, by actually serving people rather than just going and selling life insurance for the sake of selling life insurance in the way that your company wants you to, which quite frankly is just not effective. The reality is the world that we're living in right now, people are making decisions way differently than they were 10 years ago, and you need to be able to reach them on a different level. Their concerns are different, their needs are different, all these different things are going on. The way people are really, really in a different mindset with what's going on in the world right now. So you need to be able to reach people where they are. And that's what my membership platform is going to be all about, is helping people learn that. So if you have any questions, go ahead and chat it down there. You'll notice down below there's a new join button next to the subscription button. You click on that, take a look at the offerings that we have. Membership prices literally start at $2.99 a month. It is, to me, the biggest no-brainer in the insurance industry right now, what we're going to be offering. But I wanted to do it that way on purpose, intentionally, to be able to serve as many people as possible. So anyway, I hope that helps, guys. I hope if you have any questions, I hope you do engage. And go out there, have a blessed, inspirational day, and reach out if I can help in any way. All right, take care.